Number 1. Credit utilization has a big impact on your credit score. Let's say you have a credit card with a credit line of $1,000 and this is your only source of credit. According to Chase, using less than 30% of your total credit available will boost your credit. So if we spend no more than $300, things are looking positive for us. However, once we toll above that line, such as spending $400, $500, and so on, our credit score will take a hit once it's reported to credit bureaus. Number 2. Being an authorized user can boost your credit. Whether it's positive or negative depends on how the credit card is used. For example, if the account owner regularly keeps credit utilization low and they make all their payments on time, our credit will go up when it's reported. But if they commonly miss payments or they use too much of their credit, it will impact yours negatively. Here are some more upsides to being an authorized user. When you're added to someone's card, this is not counted as a hard inquiry, which we will mention later. The account owner themselves takes the hard inquiry instead of you. The other bonus is that if you know they're going to start missing payments, you can call the card company at any time and remove yourself as an authorized user to avoid any credit reports from bothering you. Number 3. Credit is reported on your statement closing date. You have a period of time from spending money on something like a credit card before it's actually reported to the bureaus. What this means is that if you utilize too much of your credit and you're worried it will lower your score, you have until a statement closing date to make a payment and lower the utilized amount. So just because we spent $600 on a $1,000 card does not mean we're going to take a credit hit as long as we can lower it before the reporting date. Number 4. Not all credit inquiries are the same. When you have your credit checked by a lender or company, it falls into 2 categories of either being a soft inquiry or a hard inquiry. A soft check happens from things like background checks, check your own credit, utilities, and other non-lending purposes. A hard check happens when you want a mortgage, a new credit card, a car loan, and other lending purposes. The key takeaways are that soft inquiries don't affect your credit, while hard inquiries temporarily affect it. Hard pulls are visible to other lenders and stay in your credit report for 2 years, but only affects it for around 12 months. Number 5. Hard inquiries have time limits. The hard checks that do affect your credit have some built-in leniency. If you're applying for something like a mortgage or car loan, you have a grace period between 14 and 45 days to do multiple hard inquiries, and they'll only be counted as one total inquiry. This allows you to shop around and seek out the best interest rate that you can get, and you won't destroy your credit in the process. Number 6. Tax brackets are marginalized. In the US, we have federal tax brackets that range from 10% to 37% that are based on your income. Let's say, for example, that you currently make $45,000 per year as a single filer. What this means is that, based on your tax bracket, you are taxed at 2 different rates. For the first $11,925 that you make, this portion is taxed at 10%. Then for the remaining $33,075, you'll be taxed at 12%. Now let's say your boss decides to give you a raise of $5,000 for a total of $50,000. This puts you into the 22% tax bracket. But it's important to know that this money won't affect all of your income. For the next $3,475, you are still taxed at 12%. Only the remaining $1,524 will be taxed at the new rate of 22%. Number 7. Subsidized versus unsubsidized loans. Not all student loans are the same. In fact, it's possible to accrue interest on a student loan before you've even graduated from college. With an unsubsidized loan, the interest starts accruing the day you take the loan out. Let's say you have a loan for $10,000 at a common rate of 5.5% interest. By the time you graduate 4 years later, that loan has already added around $2,400 in interest. While with subsidized, the government ends up covering that interest while you are still in school. So my tip is that if you have unsubsidized loans, making small monthly payments during college will cut out a lot of interest in the long run. Number 8, your tax refunds are not bonuses. It's in the name, but a tax refund is just a refund on how much you've overpaid your taxes. When you have a job, taxes are taken out based on your W-4 settings. If the company takes out too much for your taxes, you get a refund. Likewise, if too little is taken out, you have to pay the government even more money. Let's say you have a refund for $3,600. That means you overpaid your taxes $300 per month and gave the government an interest-free loan. You know they would never do that for you. To fix this, you can use a withholding calculator from the IRS where you can include your wages, deductions, and tax situation to know how much should be withheld, then you can update it with your job on a new W-4 sheet. Number 9, your mortgage payment fluctuates. Most people buy conventional fixed rate mortgages when they buy a home, and at first you assume your payments don't change. While it's true that your rate won't change with a fixed rate, other things will. A mortgage payment can be broken down further and will include property taxes and homeowner's insurance, which increase all the time. Depending on your situation, the payment may also include fees to the HOA as well as fees for private mortgage insurance. All of these things add up and they will drastically affect your mortgage bill. Number 10. You don't need to pay PMI forever. Private mortgage insurance is a fee added to conventional mortgage loans when you don't have 20% of the purchasing price available at closing time. This fee does not go towards the loan and it only is in place to protect the lender in case you default on the loan. But not everyone knows that you can actually remove this fee once you have 20% equity in a home. To keep it simple, let's say you bought a home for $100,000, but you only managed to put $5,000 down at closing. This leaves you with 5% equity and $95,000 owed. But a few years have passed and now your total loan is $90,000 owed and the house is appreciated to $120,000. You would be eligible to remove PMI from your mortgage payments to save yourself money every single month. But every lender has different steps to do this, so you'd have to formally reach out to them. The alternative is that once you have 22% equity in the house, it will automatically fall off. However, this is only based on the original purchase price, so if you are calculating it based on appreciation, you're going to have to formally reach out to them just like in the other scenario. Number 11. Credit cards are safer than debit cards. Debit cards are an easier way to take out money from your checking account, whereas a credit card is an easy way to pay for something and pay the bank back later. Let's pretend we use both these cards to pay for your gas, and our information was stolen at the terminal from a card reader. In the event that our debit card was stolen, the thief uses our information to make more purchases and it drains our account instantly. With a credit card, it adds onto the bill we owe the bank. The difference is how money is recovered. According to the EFTA, if you report the card stolen, here's your max liability. Within 2 days, max liability is $50. Between 2 and 60 days, max liability is $500. And after 60 days, you may end up paying all of it if somehow you didn't notice somebody was using your card. While with a credit card, you have no liability as long as you report it stolen. Credit cards also have built-in fraud monitoring, so they'll probably know your information was stolen before you even do. With debit cards, they only want to protect your money because of the EFTA, whereas with credit cards, it's in their best interest to protect you because it's their money, not yours. Number 12. You don't need car rental insurance. When you rent a car, the company is going to harass you to get insurance with them. Their insurance is primary insurance like you have with Geico or some other provider. If you get in an accident, you pay no deductible, meaning nothing comes out of your pocket. The downside is that it may cost up to $40 per day, but as long as you pay for the car with your credit card, your rental insurance kicks in automatically. This coverage is usually secondary insurance, meaning it only covers what your personal auto insurance doesn't. Except in some cases where it's primary, but that's pretty rare. But if you're driving a vehicle at all, it's very likely you have your own insurance and your credit card will cover everything else, so there's no real need to pay insurance companies even more money. There's some quick finance they didn't teach you in school. If you want more tips like this, subscribe to the channel.